Hopefully at this point you've watched the video called Financial Statement Transactions. If you haven't, it's probably time to press pause and go back and watch that video. And here's the reason. There were some transactions that we analyzed in that particular segment where we looked at the way that certain accounts were affected by financial transactions. And we did that in terms of just watching the accounts increase or decrease. We're going to go through the same transactions here in a few minutes, but what we're going to do is we're going to look at it from the lens of double entry bookkeeping, which can be a little bit confusing at first, but I've got some techniques that I think will really help you understand how to use double entry bookkeeping to record transactions. So if you haven't seen the other video, go back and watch that and then come back and join us in a few minutes. So what we look at with double entry bookkeeping, this should look familiar to you. Every business, big or small, can take all of its accounts and put them into one of these 5 buckets. So what we're going to say is that when we debit or credit, when we make a debit entry to an account or we make a credit entry to an account, we're not really saying that a debit is positive or a credit is negative, or flip it around, a credit is positive or a debit is negative. What we're simply saying is we're making an entry with a debit on the left side of an account, and with a credit, we're making an entry on the right side of the account. Simple as that. Now, a debit entry to an asset account will make an asset account increase, just because of the fundamental rules for double entry bookkeeping. But a debit entry to a liability account actually makes that liability decrease. And this could start to make sense because assets are different than liabilities. Assets are a resource of the entity. Liabilities are an obligation of the entity, something that will use resources. So it makes sense that what would increase an asset would actually cause a liability to decrease. More on this in a little bit. Now, one preconceived notion that you may have simply involves what's in your wallet or purse. Most of you have a debit and or a credit card. And so you might think, oh, when I use my debit card, my cash balance decreases. Well, that's true. It is true. But you have to think about it. For a financial institution, for your bank account is actually a liability for that bank because it's your money. They're holding on to it, but every time you make a bank deposit, your financial institution as a business treats this as a liability, okay? And so when you use your debit card to go see a movie, go out to dinner or whatever, their liability to you actually decreases. That's why it's called a debit card. Because on the bank side, they're going to debit that liability. As you take money out of the bank, they don't owe you quite as much. So try to just disconnect this concept of debit cards and credit cards from the study of debits and credits. I think that will help you understand the fundamental rules just a little bit more clearly. Let's explore these debit and credit rules in just a little bit more detail. Now, what we're going to use is something called T accounts. For every one of those accounts that we looked at with the financial statement transactions, we can take that account and we can express it with this representation of the letter T. And what's going to happen is your debit transactions are going to be on the left side, your credit transactions are going to be on the right side. Sometimes people do abbreviate these with DR and CR. What that simply means is debit record, credit record. I want you to think about it as left and right. So if we take a look at the cash account, we know that in those transactions we have some things that were causing the cash account to increase. Any transaction that makes your cash increase, you're going to record those dollars on the left side of the account. And any transaction that causes your cash to decrease, you're going to record those dollars on the right-hand side of the account. At the end of any particular time, what's going to happen is you're going to add up all of your debits, add up all of your credits, and subtract the larger balance from the smaller balance, and this account will either have a net credit or a net debit balance. More on that when we get into the actual transactions. So, learning the rules. How can we have a convenient way for memorizing these rules? Here's what I recommend for students. This seems to work for a lot of people. I've been teaching this class for almost 14 or 15 years, and this has worked for a lot of people. Memorize what happens with cash. Cash is an asset account. It's a resource of the company. So you know cash goes up with a debit. Just memorize it. If you know that cash increases with a debit, then you can be confident that every single asset account will go up if you make a debit entry. All assets will behave the same. And it might go without saying, but let's say it. If you make an asset account increase with a debit, then a credit entry will cause that account to go down. Now, assets and expenses behave the same way. So we get down here. If you want an expense account to increase, make a debit entry to it. If you want an expense account to go down or decrease, make a credit entry. Then what you're left with is the liabilities, owner's equity, and revenues. Just remember that those behave exactly the opposite. So liabilities, owner's equity, revenues, they all decrease if you make a debit entry to those accounts. And if you want those accounts to increase, you make credit entries to those particular accounts. So as you kind of learn the mechanics of bookkeeping, and those mysterious debit credit rules are so confusing, use this as a tool. In fact, I recommend when you get to exam time, write this chart on your exam. Make this the first thing you do. A, L, O, E, R, and E. All you have to do is write that out. In fact, if you do it that way, it's very soothing because it spells aloe right there. And then you've got your revenues and expenses. If that helps, hopefully it helps. Hopefully it's soothing like aloe to you. Just remember, memorize that assets go up with a debit, down with a credit. Expenses behave the same way as assets. The other three accounts behave exactly the opposite. Now, you're still going to have to spend some time learning what types of accounts go into assets, what types of accounts are liabilities, what are owner's equity, revenues, and expenses. But at least you'll have the mechanics of the bookkeeping with a firm grasp so you can record those transactions. Okay, so remember that accounting equation, assets equal liabilities plus owner's equity. What you're going to see here, and hopefully this helps kind of drive things home. Remember from our discussion just a few moments ago that if you want to make an asset account increase, you make a debit entry, basically an entry on the left side of that account. And if you want to make it decrease, you make a credit entry. Now, this is not a class in algebra, but hopefully you remember from algebra that when you rearrange an equation and you, for example, move something from one side to the other side of the equal sign, it changes sign. It goes from positive to negative or from negative to positive. And the same is true with our double entry bookkeeping. So if you look at this, that's one of the reasons, that's one of the ways you can remember that over here, if you want a liability to go up, you need to make a credit entry to it. And if you want it to go down, you make a debit entry. So what we're seeing here is, on this side of the equation, a debit entry makes the account go up. On this side, a debit entry makes the account go down. Over here, assets, credit entry makes the asset decrease. In this side, a credit entry makes it go up. And the same is true for stockholders' equity because it's on this side of the equal sign. Now, you might be thinking, and if I go back a little bit here, you might be thinking, well, didn't you tell me that revenues and expenses kind of play into that? Yeah, they do. So let's look at this a second. Remember this concept of retained earnings. And revenues will cause retained earnings to increase because revenues increase the profit or the net income of the business. So anything that causes income to increase will ultimately cause retained earnings to increase, and retained earnings is part of stockholders' equity. That's why a revenue account also goes up with a credit, just like stockholders' equity, because when revenues increase, stockholders' equity increases. Think about more customers, more customer revenue, more profits, it's going to be a more valuable company. Of course, if our revenue goes down, that's going to cause our profit and our stockholders' equity to go down. Now expenses, remember, expenses have the same behavior as assets, right? Remember that from a few slides ago. Expenses go up with a debit, down with a credit. Just the same as assets over here. Well, think about it this way. Expenses are on the other side of the equal sign here, and expenses cause owner's equity to decrease because expenses will reduce your profitability. The more expenses that a business incurs, the less profitable it will be. So to the extent that you're incurring more expenses, this debit here is really reducing stockholders' equity, okay? And to the extent that you have lower expenses, you'd have more profit, more stockholders' equity. So this kind of expands the accounting equation and hopefully sheds a little bit of light for you. We're getting close to recording those transactions once again, but this time with debits and credits. The cycle is what you saw in the previous video. Analyze the transaction, figure out what accounts are going to be affected, should those accounts increase or decrease. Record the transaction. This is really where the major difference is. Instead of using pluses and minuses, we're going to start using those debits and credits to affect the accounts, to cause them to increase or decrease as we determine. Then we summarize. We're going to summarize these in the T accounts. And we're going to look at that in a few minutes. Prepare the trial balance, prepare the financial statements, just like we talked about before. Same chart of accounts that we dealt with before. I may introduce a few extra accounts. This is just to kind of give us the roadmap. So let's look at those transactions. Again, these are the same transactions we dealt with a few minutes ago when you watched the other video. So we're going to go through them a little more quickly just because you've already seen them. Remember that the owners invested $10,000 in exchange for common stock. So analyze. What accounts are being affected? Well, the company is receiving cash, so I know we need the cash account. And the owners are receiving common stock, so we have to record that in the owner's equity section for the corporation. So let's choose cash and common stock. Next question is, all right, let's start with cash. Did it increase or decrease? We know that cash increased because the company received funds from the owners. So what we want to do here is we want to make a debit entry to the cash account. Debit entry will cause the cash account to increase. Now the common stock account is also increasing, so we're going to make a credit entry there. Remember, debit doesn't necessarily mean plus or minus. Credit does not necessarily mean plus or minus. It depends upon the type of account to which you are applying the debit or credit entry. A debit makes cash asset account increase. A credit, on the other side of that equal sign with the accounting equation, a credit makes the common stock owner's equity account increase. Now we're going to use some of that cash to purchase the computer. You might remember we spent $300 on that computer. Now, this initial $10,000 debit, it's still here because that's going to be accumulated in this account. We spend $300 to buy the equipment. Start to think about which accounts are being affected, cash and equipment. We know that the cash is going to decrease because we're spending money. And if $10,000 debit made the cash account increase, a $300 credit entry will make the cash account decrease. And then we have another asset. Equipment is an asset, just a different type of asset than cash, but it's still an asset, so it's going to increase with a debit entry. Now, I should bring in the concept of a journal entry. A lot of times when I teach this class, I don't prepare journal entries for each one of these transactions, but we really would be using journal entries, and we'll explore that in the classroom a little bit more. But the actual journal entry that would be recorded in the general journal would be this. We're going to list our cash account, and we would say, okay, cash, the cash is a credit of $300, and then we're going to list this equipment account right here with a debit of $300. So what we would do is actually initially record this journal entry. And when I say record the journal entry, imagine you're sitting at a computer terminal with a keyboard and a mouse, and you need to record this transaction. You're going to click new transaction, and you're going to date the transaction, and then you're going to make a debit entry to the equipment account and a credit entry to the cash account. Click save. That transaction is recorded. Think about it as being that way. And maybe some of you have even used QuickBooks or some other general ledger accounting software, and you may have done some of these types of things. After you record the journal entry, you decompose it into its components. So the debit that we made here, and I didn't even label this as debit, I just know that since it's on the left-hand side, it is a debit. That gets posted to the equipment account, and then this credit to cash gets posted to the cash account. One last concept before we move on. Let's figure out what this account balance is right now. The total of our debits is $10,000. The total of our credits is $300. $10,000 minus $300 equals $9,700. So at this given point in time, if you wanted to figure out what is the actual cash balance, all you have to do is subtract your credits from your debits, and the net balance of this account is $9,700 debit balance. That tells you you have a positive cash balance, because the normal balance for an account is whatever balance makes it positive. It's normal for this account to be positive with a debit. It's normal for this asset to be positive with a debit. We're going to explore this in a little bit more detail as we record the next transaction, borrowing some money from the bank. So up to this point, we have a cash balance of $9,700, and we know that we're going to get some more money right here from the bank because we still have to buy that espresso machine and do some other things. So we already have the initial two transactions here. Then we borrow some money from the bank. Well, look what's going to happen. When you borrow money, the bank gives you cash. So we're going to make a debit entry to the cash account. That's going to cause this account balance to increase, and the new account balance will actually be $20,700 right here. And over here, now we're on the other side of the accounting equation. Remember, with a liability, if you want the liability to get bigger, you make a credit entry to the account. So this note payable account is actually going to have, after this transaction, a balance of $20,000 even, which makes sense because that's the amount of money that we currently owe the bank. That will change in the future as we make payments and the principal balance goes down. But for now, we owe the bank $20,000. A normal balance for a liability account is a credit balance because that is the type of balance that will create a positive value, a positive liability. Whereas, and I know it might be getting a little redundant, but this is a confusing concept, whereas the normal balance for cash and asset is to be a debit balance because we have currently $20,700 in the bank, and we're glad that's a positive balance because we need to purchase an espresso machine. So let's purchase that espresso machine. Now, when we do that, you might remember from the previous video that we didn't actually pay for the espresso machine right away. Our vendor extended trade credit to us. So we've got the equipment account here, which is an asset, and accounts payable, which is a current liability. We already had $300 in the equipment account. So before any transactions were recorded right here, we have $300, that was the computer. Now we're going to buy the equipment, which is the espresso machine. So this asset is going to increase with a $9,600 debit. Accounts payable, because it's a liability, it increases with a $9,600 credit. Let's figure out what the account balances are at this point in time. The liability will have a $9,600 balance. And now what we have to do is add these two debits together. That's $9,900. Our equipment balance now jumps up to $9,900. It's time to pay some money to that vendor that sold us the espresso machine. You might remember that we paid a $5,000 partial payment to that supplier. So think about what's happening. Which two accounts are going to be affected? We know that cash will be affected because we have to spend that money. And then we might recall that we have this liability to our vendor called accounts payable. That liability is probably going to decrease. So in order for cash to decrease by $5,000, we need to make a credit entry to that account. Now, one of the rules of double entry bookkeeping is that for every debit there's a credit. Or actually what I should say is the total of your debits will equal the total of your credits. So we just made a credit entry to this account for $5,000. That means we need to debit some account or some combination of accounts totaling $5,000. Just so happens that if you make a $5,000 debit entry to a liability, like accounts payable, it's going to cause that liability to get smaller. So what you can see is this journal entry that we would record. In fact, I'll just write the journal entry here. It would be debit accounts payable $5,000, credit cash $5,000. As you can see, this debit causes the accounts payable to decrease. This credit causes your cash to decrease. The journal entry is such that your debits equal your credits. Debits over here equal the credits. And now we have some new balances to calculate as well. 9,600 minus 5,000 means that our accounts payable has a new balance of 4,600, which makes sense. The liability is getting smaller. You can see it getting smaller here. And over on the cash side of things, we used to have 29,700. Now we have 24,700 of cash. That's this 30,000 minus 5,000 here, which brings you down to 25,000, minus 300 is 24,700. This transaction's super easy. Just like before, all we did was place an order. We did not receive the furniture, so we do not have an asset that needs to increase, and we don't have a corresponding obligation. So there's no accounts payable. We didn't spend any money. There's no reduction in cash. Wait for that transaction to happen, because in a minute, we're going to receive that furniture, and then we have to break out the debits and credits. Hopefully by now, you're really starting to get the hang of these debits and credits. And we can illustrate that further with receiving this furniture that we ordered. Now, you might remember that we paid for some of that furniture using cash, and then some of it, the vendor extended us trade credit. So we actually have a situation here where we have 3 different accounts being affected. And because that's the case, I want to show you what the journal entry is going to look like. So if you were to record this in the form of a journal entry, you would make a debit entry to the equipment account in the terms of in the amount of $9,000. And then what would happen? Okay, remember your debits have to equal your credits. Right now we have a debit of $9,000 being made. Well, we spent some cash. Cash decreased by $4,000. So we're going to end up making a $4,000 credit entry to the cash account. The remaining $5,000 is actually a liability called accounts payable increasing. So in this journal entry right here, total of debits is $9,000. Total of your credits, these two combined, is $9,000. Even though this credit causes cash to decrease, this credit causes accounts payable, a liability, to increase. Then we can take each part of these, this journal entry, and we can put the $9,000 up here. That's going to make this account become $18,900. And we can take the cash, bring it all the way over here. That's a $4,000 credit, which reduces cash. It's going to bring our cash balance down to $20,700. And then finally, as we break apart this journal entry, the $5,000 credit entry to accounts payable, pretend that you can still see all that line. That's going to cause our accounts payable to increase from $4,600 to $9,600. One final transaction to record. And you might recall, we're going to be dealing with accounts payable in a minute here. We already had some transactions in accounts payable for this period. We purchased the Espresso machine. We paid some of that toward our vendor. Some of the furniture that we bought, our vendor gave us credit. But now we're going to receive inventory. And inventory, we're actually going to use some vendor credit because they extend credit to us. Inventory is an asset. Kind of like cash is an asset, cash is a resource. So is inventory. We're going to use this inventory to make products that we will ultimately sell to our customers. So this asset is positive with a debit entry. Our vendor does not require us to pay for it immediately. They extend trade credit. So this $600, instead of using something like cash, we actually increase our liability to the vendor. Now, the previous balance in this account had been $9,600. I didn't list it there, but it was $9,600. If you look at this, and this is actually kind of a good way to look at things, the debit and credit of $5,000, they cancel each other out. So let me just actually do that for illustration purposes. Pretend these don't exist because they're going to cancel each other out. That means that these two credits right here added together give us our final accounts payable balance of $10,200 credit. And it's important, I'd like to point that out right now, to say that this balance has a $10,200 credit balance, because if it had a debit balance, that would actually mean negative accounts payable, because for a liability, a debit is a negative. We need to see that this is positive, and that's normal for the accounts payable liability balance to have a credit amount. And of course, this is a really easy T account to balance, just because there's only one entry. $600 debit leaves us with a $600 debit balance. All right, we've recorded those transactions, and we now have our T accounts listed up here. So as you take a look at things, what you're seeing is, here's every transaction we had for the cash account, the inventory, the equipment, everything for the accounts payable. Remember that $10,200 balance that we talked about a few minutes ago? I know my handwriting is not nearly as nice as what I have typed up here for you, but there's the $10,200 balance. And what you start to see as we bring this together, remember the accounting equation, and it's at the top right here. Asset accounts normally have a debit balance. So seeing that this is $20,700, that's a positive $20,700, positive $600, positive $18,900. Go to the other side of the accounting equation. Credit balance is here, $10,200, $20,000, $10,000. Those are all positive balances for these two liability accounts, for these two, or for this single owner's equity account. I almost said two because eventually there's going to be a retained earnings account here. It just has no balance, so I did not include it because we haven't conducted any operations. There are no earnings to retain at this point. Okay, so let's bring this all together into a trial balance. What I'm showing you here are just the three asset accounts. And what I'd like to point out is that what you can see, the trial balance is simply a listing of the accounts and their balances at a point in time. This is as of the end of January 2018. In a future video, we're going to look at February 2018, where we actually start to sell some coffee and some food, and we're going to have some revenues and expenses. But right now, we just have these three assets, two liabilities, and an owner's equity account. And what you can see is that whatever the current balance is, $20,700 debit in this case, just gets listed right there as a debit. And the same will be true for your inventory and for your equipment. And for those liabilities and owner equity accounts that normally have credit balances, you can see, for example, right here, the ending balance in accounts receivable was $10,200. We list that in the trial balance with a credit amount of $10,200. And I think you see what's happening. The same is true for notes payable and for common stock. Now, what you can see here, remember that the amount of your debits needs to equal the amount of your credits. For every one of those journal entries we recorded, there was a debit, there was a credit. I guess in a couple instances there were a couple debits or a couple credits, but the debits always equaled the amount of the credits for each individual entry. And that's what allows this trial balance to stay in balance. You can see that the total of these debits is $40,200. The total of these credits is $40,200. And the truth is, any modern accounting software package won't let you post an unbalanced entry. But there was a point in time when people used to do this with pencil and paper where it was possible to make some kind of a clerical mistake, and it was really important to see that these accounts balanced, the debits and the credits, because that meant that you had captured all portions of the transaction. Where we're going to go with this next in a future video, we're going to see how this information could be used to form a rudimentary balance sheet. And then beyond that, we're going to take a look at some income statement transactions, how to record those, and how to turn those into an income statement.